Thank you everyone today for joining us for our presentation about the Southern Company. The Southern Company is often considered one of the most prestigious firms within the utilities industry. Today, I'm Justin Park, and I'm joined here today by Lindy Candidate, Azim Fazil, August Jordan, and Sneh Ujina to discuss our sell recommendation on the Southern Company. We established a base case price of $63.32, which represents about a 6.4% downside from Southern's last closing price of $67.65. We had a peer group of Exelon, Dominion Energy, Duke Energy, NextEra Energy, and Sempra. Now Lindy's going to tell us a little more about the business.
Thank you, Justin. Southern operates as a holding company, providing energy to 9 million customers, has operations in 18 states, and has over 31,000 employees. The firm is the third largest electric utilities company in the U.S. by annual revenue and has a market cap of approximately $74 billion. Southern owns the outstanding common stock of Southern Nuclear, Southern Gas, and Southern Power. One of the main reasons investors are attracted to utility stocks are due to dividends, which Southern has increased for 23 consecutive years. The firm's primary subsidiaries are located in Georgia, Alabama, and Mississippi, with Georgia as a revenue-driving state, followed by Alabama and then Mississippi. The Southeast is fundamental to Southern's success because it's its primary geography. As you can see here, Alabama Power and Georgia Power lead the firm in net income, yet Mississippi Power and Southern Gas decrease the firm's profitability. We expect earnings and dividends to continue increasing, but profitability to continue lagging peers in the future, even with Vogtle 3 and 4 at 100% operation. We also anticipate key leverage metrics to remain stable throughout 2028, but unforeseen projects could impact the firm's leverage in the future.
Southern intends to achieve its net zero goal with the assistance of these renewable energy types. Southern has a diverse workforce, reaffirming Southern's position as a firm leader within human capital development. Southern has improved upon its board structure score, remained the same for shareholders' rights and compensation, and worsened within auditing, and this can be explained within our team governance key concern highlights. We will touch up more within the environmental section within our conflicting green mindset investment thesis. I'm now handing to Justin to discuss investment criteria.
Thank you, Azim. So here's an overview of the framework we use to evaluate equities within the utilities industry. One thing I'd like to focus your attention on is the high ROC versus WACC. In such a debt-intensive industry, we believe that efficient capital deployment that creates excess value for shareholders is critical for utilities firms. Now I'm going to pass it off to August to discuss our key investment highlights.
Considering our investment criteria and deep research into Southern Company, we issue a sell recommendation with an option of a convertible hedge strategy due to the company's negative valuation, negative dividend yield spread, conflicting green mindset, low management conviction, and limited growth opportunities. Now Justin will go through our first investment thesis point.
Yeah, so I'm here to talk about the negative valuation. So here's a brief overview of our blended valuation model. One model I'm going to discuss today is the sum of parts, which we weighted at 40%. We view Southern subsidiaries as independent business units that have differing growth rates in their own unique strategic profiles. We looked at the EPS contribution of each of these subsidiaries and applied a forward PE to arrive at our target range of $59 to $72 for the sum of parts model. Furthermore, our Monte Carlo simulation affirms our overall target range of $56 to $72, with about 60% of those simulations falling within that target range.
And building on our Monte Carlo and valuation, we see two potential volatility drivers for 2024. The implementation of Vogtle 4 and interest rates. This brings us nicely into our second investment thesis point, negative dividend yield spread. As Lindy mentioned earlier, one of the main reasons investors seek capital into the utilities industry is due to its dividends. However, this strategy really only makes sense whenever the dividend yield is trading at an excess over the risk-free rate. As we can see on the chart up here, Southern's dividend yield has been trading at a nice premium over the 10-year treasury for the past decade. However, as of speaking, and interest rates surging the past 2 years, a Southern shareholder would now receive a higher yield investing in a 10-year treasury than investing into Southern Company due to its dividends. We see this as one of the main headwinds for the company in 2024.
Moving to our third investment thesis point, Southern's conflicting green mindset. Within Southern's most recent proxy statement, shareholders requested that Southern publish an annual feasibility study speaking specifically towards firm progress in achieving their net zero 2050 goal. However, the board of directors denied this request. Further, there are multiple key Southern executives seated on various trade associations' board of directors that actively seek to contradict Southern's green mindset. We believe this conflict of interest will prove to make Southern less attractive within the short and long term. And this ties in nicely into our fourth investment thesis point, Southern's low management conviction. Shown here we believe Southern's management performance could lead to operational roadblocks affecting the firm and its value. Shown here on the right is a representation of Southern's inefficient cost discipline. We believe this can be best characterized within major budgetary cost overruns, and this is shown nowhere better than in the projected and the actual exorbitant costs of Vogtle 3 and 4 and the failed Kemper CCS facility.
Yeah, so extending upon Azim's analysis of that project mismanagement, we ran a detailed analysis on the total shareholder value that was destroyed through delays from Kemper and Vogtle. This figure was approximately $10 billion from 2013 to 2023. This represents about 15% of the company's total market cap.
Speaking further to Southern's substandard management confidence, shown here on the far right is a reflection of low insider confidence amongst Southern executives. I would now like to bring your attention to the failed Kemper CCS facility. This is a representation of federal aid of the tune of $382 million in an endeavor to successfully deploy the plant's carbon capture storage facility. We believe if Southern is found in violation of the False Claims Act, the monetary damages of this lawsuit could balloon to well over $1.2 billion. Alongside Southern's conflicting green mindset and Southern's inability to execute, we are concerned for Southern's ability to respond to climate risks.
Now moving into our last investment thesis point, limited growth opportunities. Although Southern Company has a defensible market position, we believe the firm has limited growth opportunities due to its percentage of regulated business. More than 90% of Southern Company's earnings come from states that regulate their utilities, which means utilities firms control the entire value chain. This regulatory environment is good because customers are locked in to the utility provider that services their area. However, these companies are subject to strict regulation put upon them by public service commissions. As a result, we believe Southern Company could have trouble expanding, which would create a lack of geographical diversification for the firm. One of the main growth levers for Southern Company to expand is for people to move to one of the 7 states in which the firm operates in, which is why we consider them to have limited growth opportunities. Southern Company has underperformed financially and destroyed value. Its return on invested capital has consistently been inferior to its weighted average cost of capital since 2020. Considering this and their $48 billion capital deployment plan, we are not confident that Southern Company's investments will prove fruitful for the growth of the firm.
We do anticipate rate base growing by 5.5% annually. This low to mid growth rate is mainly driven by the company having older infrastructure compared to peers and the company investing less of its revenue into capital expenditures. Now I'll switch it back to Sneh, who will go through some key investment risks.
Thank you, August. We use the PESTEL framework to analyze 4 key investment risks furthering Southern Company's sell recommendation: increased regulatory action, macroeconomic conditions, extreme climate, and cybersecurity. I'd like to highlight extreme climate and cybersecurity. Increasing global average surface temperatures have caused increased extreme weather occurrences, which can damage infrastructure and test grid resiliency. Additionally, cybersecurity is becoming increasingly important for the utilities firms as they shift further to digital platforms. Cyber attacks could leak key personal information or disable services, which would be a detriment to Southern Company's reputation and their bottom line.
To reinforce our investment thesis, we issue a sell recommendation with an option of a convertible hedge strategy on Southern Company due to the company's negative valuation, negative dividend yield spread, conflicting green mindset, low management conviction, and limited growth opportunities. To end our presentation off, Justin will quickly go through our assumptions for our convertible hedge strategy.
Yeah, so for alpha-seeking investors, we suggest that they engage in our convertible hedge strategy. This would boost the annual fixed income yield from 3.9% to 9.2%.
Thank you for listening, and we're now open for questions.
Yeah, so if I can start, I always love to see sell recommendations, right? You don't see that too often, so that's great. And one of the headwinds you guys talked about was the treasury yields being higher than the dividend for some time now, and that's one of the headwinds that expected to drive the price down, and that's how you came up with that recommendation. But going into the later half of 24, if that is expected to change, like if the Fed lowers the interest rates, and if that reverses, how would that impact your recommendation in terms of the price?
It's a great question. So if we look at, this is as of speaking right now, we anticipate the risk-free rate for the 10-year treasury going down to 3.9% in the end of 2024. At our target price of 63.32, this is would be about a 40% premium over the risk-free rate. If we compare this to the 10-year average of the premium of Southern's dividends compared to the 10-year treasury, it's about 200 basis points. So we're still well below the spread for the past 10 years.
Okay.
Does that answer your question?
Yeah. The other question I have is you also used a Monte Carlo simulation to
Yeah.
come up with some analysis. What are the variables that you looked at that could have the most impact on value? What variables did you simulate?
Yeah, so some determinants of this simulation. We saw three main drivers of growth for utilities firms: the population, as Sneh alluded to, ROE, and rate-based growth. So those were kind of the three main avenues that we used and kind of looked at. In terms of the rate-based growth, again, we saw modest growth within that category. Management had set a 6% expectation. We tapered that off a little bit to go to 5.5 just because of some doubts we have within their capital expenditure plan able to generate growth. In terms of the population growth, we see moderate growth within that southeast region, but we try not to rely on that too much because population growth can definitely be subject to variability and they're very uncertain. And then in terms of the ROE, this is a more constant because Southern's ROE has now been, for the company as a whole, has been around 9.5% for some time. So those were the three main drivers that we looked at.
Okay, thank you.
You have highlighted the risks you are seeing in this company, including the regulatory risk, inflation risk, etc. I would be curious in learning about, are you kind of bearish in the utility sector overall? Maybe perhaps you can walk us through how the financials of this company compare with the peers.
Yeah, I would love to do that. If you want to pull up our projected income statement, or the slide with the, I think Lindy went over it with the profitabilities comparing to our peers. Right, so for utilities firms, what we really like to focus on is their bottom line. Expansions within revenue don't always translate to expansions within the bottom line due to those ROE regulations. So, like we said here, we see pretty healthy growth within both the firm's EPS and dividends, but we still see those lagging behind peers, and primarily we want to highlight NextEra Energy, who is a leader both in the profitability segment and the DPS. So we see that as a major concern for the firm, and due to those limited growth opportunities, we don't really see an avenue as Southern could expand their bottom line unless they want to dramatically cut costs somewhere else or dramatically increase the rate-based growth. And those obviously come with headwinds in their own, especially when you look at rate-based, the financing, equity dilutions, and interest rate headwinds that come with that. So we see that these margins will probably project out, you see, to 2027. So that's a big problem that we see for the firm, and definitely NextEra as a major competitor in terms of the financial performance.
I can add quickly on that. If we look at the gross margin, you see the biggest spread from Southern Company related to the peers. As Justin mentioned, NextEra is further along with the renewable segment, and which solar and wind are the most profitable out there, especially if you look at operating maintenance expenses, which is, you see that spread is mainly due to the companies lagging behind in the new renewables, deploying capital into new renewables.
You mentioned equity dilution. Could you explain that a little bit more?
Yeah, so when we look at how utilities firms are going to finance their, let's say, capital expenditure plan, for example, they have structured debt capital structures that they need to follow by every state. So Southern's right now is currently 60% debt, 40% equity. So we see that they had come out with plans on how they're going to finance that equity. One way is through the DRIPS program, which is just reinvesting dividends, but another was through issuance of shares. And that will definitely dilute the equity of the firm and kind of limit the bottom line growth that we see from the capital expenditure plans. And then on the debt side, like I touched already, we see high interest rates, especially right now, are going to create some significant headwinds for that capital expenditure plan and the ability to generate growth.
So if I heard you right, you're expecting that they're gonna have to issue more equity in the future to fund negative cash flow? Is that?
Yes, possibly.
Wait. If we look at the cash flow statement, right, sorry, but this is one of the main concerns of the company and the whole utility industry that we don't really address in our presentation. We see that the company is not covering its capital expenditures by the operating cash flow. And even though they're paying out dividends from financing activities, they have to either issue more debt every year to pay off their debt or issue equity, which is the firm does every year. Just, yeah, if you just look at the cash flow of the business every year, the company has to bring in external financing,
Yeah.
which is never really a good sign if you look at from a cash flow perspective.
Perfect. I'm gonna jump in again because I wanna make sure, I'm really interested to hear about, and you did answer that question, thank you. I'd love to hear about your convertible strategy. that you're
Yeah.
recommending.
Do you want to pull up the case study that we have? And you can just go to the last slide as well of the presentation. Yeah, so to break down this convertible hedge, let's go over what the purpose is and then the more technical aspect. So the purpose of the convertible hedge is to create a delta neutral position. This means that any fluctuations in the convertible price that we purchase will be offset by the short position that we establish. So how does this boost the annual fixed income yield? Well, when you establish a short position, you receive that cash up front. So you see that our total net cost actually decreases by almost 60% when we establish that short position. And that's how we're able to boost that fixed income yield. Now, how do you create that delta neutral position? I think this is definitely the most technical and difficult part of the convertible hedge. And this is why we only suggest it for alpha-seeking investors, those who have an increased risk appetite. We're going to take the total convertible shares, 10 times the conversion ratio of 11.8, and multiply it by the convertible bonds delta of 0.7. That creates our delta neutral position. So any increase or decrease in the convertible price will be offset by fluctuations in our short position. And for that kind of hedges risk for investors. But this position, depending on your risk appetite, will really require daily, weekly, or monthly adjustments in your delta to maintain that delta neutral position.
So your sell recommendation, it sounds like it's based on two factors, one on valuation and two on fundamental issues you see with the company. Is there anything in the near future which may happen to the company which may change your view on the future of the company?
So we do have a bull case in 1 year forward where the stock would be trading at a 4.5% premium or upside. And if we look at obviously treasury rates, and the US Treasury is a huge deal for the company, not only financing costs, but also investors seeking the capital into fixed income instead of stocks. We do anticipate if Vogtle 4, the stock price has been very volatile the past couple of years due to the implementation of Vogtle 3 and 4, because it's not only about these nuclear projects, it's about the shareholders trusting the management. So we see that they release Vogtle 4 earlier than they're talking about H1. If they release it early H1 in the next couple of months, that's going to see a boost in the stock price. And one of the main growth levers the company talks about is the economic prosperity in the Southeast, which we agree with. We have addressed the population growth, the business growth in the Southeast. But if this is growing higher than expected, it's definitely going to grow the rate base of the company. And 1 year forward, we can't really control the weather conditions. As an electric utility company, if there's milder than usual conditions, the earnings are going to be growing higher than expected.
And just to piggyback off that point real quick, we saw a 16-cent EPS downdrag because of more mild winter conditions. So I think people tend to underestimate how much of an impact that weather will really have on the firm's earnings. So again, with favorable weather conditions, maybe a more tempered spring than usual, a little colder weather, we can see about a 4 to 5% uplift in their EPS just because of that weather alone.
I also think fundamentally, if you want to look at it, if the firm could diversify where their primary locations are at and not face so much concentration risk, that would help out a lot.
We're at time.